All right, let's talk about Lundin Gold. This company, wow, it's gone from being just a promising developer to a literal cash machine. But here's the thing, its stock is sitting at an all-time high. So the big question for all of us is, has the ship already sailed, or is this thing just getting warmed up? So yeah, this is the dilemma, right? This is what every investor is staring at. You have to ask yourself, has all the easy money been made here? Or is this just the base camp for the next big climb? Well, that's exactly what we're going to dig into today. Okay, so to really get what makes Lundin Gold tick, you gotta look at the heart of the operation. And it really all comes down to one single asset, its incredible Fruta del Norte mine down in Ecuador. And listen, this isn't just any mine. This thing is the absolute engine driving the whole company. Yeah, I mean, it's so ridiculously profitable that you'll hear people call it a high-margin ATM. And that's not really an exaggeration. Because of its incredibly high-grade gold, it just prints cash, quarter after quarter, like clockwork. So what we're looking at here is one of the highest grade gold deposits on the entire planet. And what that gives Lundin is something super rare in the mining world, predictability. I mean, their production is basically locked in for years to come. That's almost unheard of. But, and this is a big but, there's a trade-off. That amazing stability comes at the cost of immediate production growth. And that's what's making some investors a little bit nervous. Okay, let's talk cost for a second. In the mining game, the magic number everyone looks at is the all-in sustaining cost, or AISC. Basically, it's the total all-in cost to get one single ounce of gold out of the ground and to the market. Now, you might look at Lundin's numbers and see their costs are actually guided to go up. And you'd think, wait, that's bad, right? But here's the twist. It's actually a good thing. It's what I'd call the good kind of cost increase. See, it's only happening because as the price of gold skyrockets, they have to pay more in things like royalties and profit sharing. To put it simply, their costs are only going up because their profits are going way up. So what does a company do with all that cash that's pouring in? Well, in Lundin's case, they build what you might call a dividend fortress for their shareholders. And this isn't some tiny dividend either. We're talking about 80 cents per share per quarter. Look, a payout this aggressive is pretty rare in this space, and it turns the stock into this really interesting hybrid. You get the potential for growth from the gold, but you're also getting a really significant steady income stream while you wait. And don't worry, they can absolutely afford to be this generous. Their cash flow is just massive, and they're splitting it up in a really smart way. A huge chunk goes right back to shareholders, the dividend. Another big piece keeps the mine running smoothly. And then there's this. A very significant $85 million is being pumped into the single largest exploration campaign in the company's history. They're looking for the next big one. So you see the picture, right? You've got this rock-solid foundation, but then you've got this stock price that's already hitting all-time highs. And as you can imagine, this has the market totally divided. So let's do it. Let's break down the bull case versus the bear case. It's pretty simple, really. On one side, you have the bulls. They see a high-yield safety net, a stock that's perfectly set up for high gold prices. But on the other side, you've got the bears, and they're arguing that this thing is priced for absolute perfection. The valuation is stretched, and there is zero room for error. Okay, let's dive into the bull case. The argument here is that as long as gold prices stay strong, and boy, are they strong right now, the profits are just going to keep rolling in. That big dividend we talked about, it acts like a floor, a safety net under the stock price. Plus, it creates a total nightmare for anyone trying to bet against the company. Think about it. Short sellers have to pay that dividend out of their own pocket, which makes shorting this stock a really, really expensive gamble. All right, now for the other side of the coin, the bear case. Bears will point out that analysts are already getting pretty cautious. A lot of them are rating the stock a hold or even a reduce. And the core argument, the big idea here, is that all the good news, the high gold price, the great mine, it's already baked into the stock price. It's priced for perfection. And that makes the stock incredibly vulnerable to any little hiccup, a problem at the mine, a sudden dip in gold prices, anything. So you've got these two really strong opposing views. How are the short-term traders handling this? Let's switch gears a bit, move away from the long-term story, and look at the short-term price action. Let's open up the trader's playbook. What traders are seeing right now is a really clear trading range. The stock's kind of hovering around 112 Canadian, and you've got this strong floor, what we call support, down around 108 bucks. And then there's a ceiling or resistance up near 117. And those two levels, those are the key battlegrounds right now. So for traders, this whole situation screams discipline. The general feeling is that the easy, straight-up money has already been made. So the strategy is simple. Don't chase the breakout. Instead, the play is to buy the stock on dips when it gets closer to that 108 support level. And then you sell the rips, taking profits when it rallies up toward that 117 resistance. It's a classic, textbook, range-bound trade. So, where does all this leave you? I mean, we've seen there are really compelling arguments on both sides of the fence. The right move for you? It really boils down to one simple, fundamental question. Are you an investor or are you a trader? Because this really sets up two completely different paths. The investor's play is all about the long-term story. You're focused on that dividend and the huge expiration potential. The trader's play? Well, you're just focused on the short term, treating the volatility between those support and resistance levels. And look, neither approach is wrong. They're just different. Let's look at the investor's thesis because it's pretty simple and powerful. You hold Lundin Gold as a core position in your portfolio. You collect that awesome dividend, which literally pays you to be patient. And what are you waiting for? You're waiting for the ultimate prize, the results from that massive $85 million exploration program. You're waiting for them to hit Fruta del Norte 2.0. And really, that's the choice, isn't it? Are you in this for the fantastic, predictable profits it's pulling out of the ground today? Or are you betting on the massive, potentially game-changing discovery it can make tomorrow? That's the question you have to answer. Thanks for tuning in.